You wake up at 2:11 a.m. because your phone lights up like an emergency room monitor. The subject line is calm, community update, special assessment notice, no siren, no warning sound, just one PDF. You open it half asleep, expecting a boring neighborhood memo, maybe a landscaping vote or a reminder about parking decals. Instead, the number sits there like a punch to the chest. $8,000, due in 45 days. And the line that hurts most is not the amount, it is the tone. This payment is necessary to preserve property values and community safety. You are shaking in bed while the sentence pretends this is routine. You look at your savings account. That account had one job: emergency fund, buffer, breathing room. Tonight, your emergency fund just got reassigned to building emergency you did not cause. HOA notices are masters of polite violence. They never say panic, they say adjustment, maintenance obligation, deferred capital need. Every line is administrative. Every consequence is personal. The document explains roofs, drains, elevators, pavement, structural updates, insurance pressure, reserve shortfalls. You read words like reserve study, capital project, board resolution. Your brain translates to one sentence: my monthly life just changed. And this is the psychological trap. Because you bought into a community to reduce uncertainty, shared maintenance, shared costs, shared governance. But special assessments are uncertainty returning with legal authority. It feels like your home got a hidden subscription fee that activates whenever the math gets ugly. Normal bills are expected pain. Mortgage, utilities, insurance, groceries. You hate them, but they are in the calendar. Special assessments are ambush pain. They bypass your monthly rhythm and land as a lump sum demand with a deadline. That is why people describe the feeling as betrayal. Not because maintenance is fake, because timing is brutal. You made all the responsible choices. You kept a cash cushion. You skipped vacations. You said no to impulse spending. Then one board letter reframes your discipline as available liquidity. Savings stops feeling like safety. Savings starts feeling like a target. Most homeowners do not ignore risk because they are careless. They ignore it because HOA documents are exhausting. Budgets are dense. Reserve studies are technical. Meeting minutes are long. During purchase, you scan fast. You trust the process. You assume major repairs are already priced into dues. Sometimes that is true. Sometimes it is not. Aging buildings, postponed repairs, rising labor costs, material inflation, and insurance repricing can stack silently for years. Then the stack collapses into one sentence: special assessment approved. And now you are learning governance vocabulary while doing emergency cash triage in your kitchen. The assessment itself hurts, but the cascade is worse. You pay from savings. Savings drops. Emergency confidence drops with it. Now every other risk feels louder. Car repair, threat. Medical bill, threat. Job instability, bigger threat. You begin pre-grieving future problems that have not happened yet. That is the finance psychology nobody talks about. A single forced payment can change your internal sense of safety for months, not because you became irrational, because liquidity is emotional oxygen. When oxygen gets thin, even small decisions feel high stakes. Do I replace the tires now or wait? Do I visit family this month or pretend I am busy? Do I keep investing or pause everything? This is how one HOA notice spreads beyond housing into identity. In group chats, everyone acts strategic. It is for long-term value. This is normal in older communities. At least they are fixing it now. All true, still painful. Because public logic and private cash flow are different realities. In public, people discuss asset preservation. In private, people move money between envelopes and hope no second surprise arrives. Some neighbors can write one check and move on. Others need payment plans, balance transfers, or personal loans. Same notice, different damage, morning rule. No doom scrolling before decisions. You do 4 practical things. First, confirm exact terms. Amount, due date, installment options, late fee policy, no guessing. Second, request context in plain language. What failed? What was deferred? What alternatives were considered? What timeline drove urgency? Third, protect baseline liquidity. Even if you must pay, avoid driving your emergency balance to zero. A wounded cushion is still better than no cushion. Fourth, create a post-assessment recovery plan, not motivation. Math. How much to rebuild monthly? What expenses pause temporarily? What risk you are carrying for the next 90 days? This does not make the notice fair. It makes you less fragile after it. Before this, notice your money map probably looked stable. Income comes in. Fixed bills go out. Small variable category for life. Automatic transfer to savings. After the notice, the map mutates. Your next paycheck is no longer next month money. It is recovery money. You stop asking, can I afford this? You start asking, what risk am I buying if I spend this? That is a darker question, but it is the right question after a liquidity hit. Because the real goal is not to feel good this week. The real goal is to reduce the probability of financial chaos in the next quarter. So you run a cash flow autopsy. Which subscriptions are still useful? Which habits are expensive stress relief disguised as necessities? Which expenses are non-negotiable protection versus ego protection? This part is uncomfortable because it reveals the difference between lifestyle and resilience. And once you see that difference, you cannot unsee it. Not every special assessment should be fought. Not everyone should be accepted quietly either. Push back when details are vague, timelines are inconsistent, or alternatives were never discussed. Pay fast when penalties are severe and your leverage is low. Plan an exit when these shocks become a pattern instead of an exception. That last point is hard to admit. Sometimes the smartest move is not heroically surviving the same system forever. Sometimes the smartest move is building a 2-year strategy to leave a financial structure that keeps ambushing you. No drama, no internet speeches, just clean math and emotional honesty. Can this property support your life, or is your life now supporting the property? That one question can save you years. At 2:11 a.m., one polite PDF turned your emergency fund into a line item. That is the part nobody advertises in homeownership content. The bill is not always the surprise. Sometimes the surprise is who gets to define what counts as an emergency. Welcome to StatPsyche.